Chairman,
yes,
Lata.
Mr. Setty, the SBI Chairman is with us. Mr. Setty, really grateful that you've pulled out time after, telling us that it is an extremely busy day for you. At first sight, what are your first views on the policy? You get a higher than expected rate cut. To be fair, your colleague Soumya was the only one who guessed it at 50 bips or forecast it. So congratulations on his behalf as well. But what are your first thoughts?
Thank you, Lata. I think on the rate front, obviously, we had some house view on that through Soumya. Probably, it was not as big a surprise for us as to the market. But CRR cut obviously pleasantly surprised every one of us. For a long time, we've been asking the RBI to have a relook at the CRR. And it's a good move in the sense that while the CRR mathematically does not impact any lending rates and deposit rates, it definitely augments the liquidity, and RBI has been providing sufficient liquidity. And also CRR will have reduction in CRR also will have a money multiplier impact.
Yes.
So that's a very positive in my view. Okay. And I hope that, though the governor has given some disclaimer that they may always relook at it, but it will be a sustained one.
Yeah. So let me just explain money multiplier to those of our viewers who don't use these words on a daily basis. What the chairman is trying to tell us is that the CRR is not a one-time. What does it mean? 2.5 lakh crore of 1% of total bank deposits, which were lying at zero, at cash, can now be lent out at 8%, 7% or whatever they choose to. It is not just that money that they make. The multiplier is every loan creates its own deposit. So whenever you go and ask for a loan, the SBI just creates a deposit in your name. And that deposit, they don't have to keep 4.5% as they used to last November. They have to set aside only 3% as cash. And again, you create more deposits. So this multiplier means, there is a fall in cost of funds for a sustained period, as long as the multiplier works. And I don't think that's very, easily understood by equity analysts, because this is not the daily thing. So I take your point on that, sir. Therefore, Mr. Setty, would you say that loan growth you may have to relook? Because if you look at your November versus November CRR, last November 24, you were 4.5 CRR. And this November, you are going to be at 3% CRR. Would you say you may end the year with a higher than expected or higher than guided loan growth?
Obviously, in the last a few months, with the availability of liquidity obviously has never been a constraint for credit growth in the last few months. But the very fact that RBI further took steps in terms of increasing primary liquidity and a durable basis is something remarkable. So, yeah, and I'm sure that, which is the stance of the regulator is more towards propelling the growth. And we are sure, I think it's a no-brainer to expect retail growth to be more robust than what we have had seen in the last few months. I'm sure that will pick up with the NMI, EMI, ratios getting improved. Two things. One is this rate cut, and the other one is that the tax rate cut, which is available up to 12 lakh rupees.
Yes.
We will be seeing some additional money in the hands of the people. So the NMI, EMI profiles of the retail borrowers is increasing, are improving. So which means that there definitely would be an improved growth in the retail. The question is the next question, before you ask, I'll answer that on the corporate credit growth. So I think we may have to see that the stage is set for availability of liquidity and a reasonable interest rate regime now. And it is for the corporates to take a call in terms of the investments. I'm sure some of the pipeline which we've had will get strengthened. And more importantly, Lata, the consumption coming back, both in terms of the housing loan-driven consumption, personal loan-driven consumption, may make everyone to look at their capex programs.
Okay. So more than capex, I want to get the margin picture, sir. Is it fair to say that your margins are going to fall in this quarter rather badly? but you will exit the year with much better margins?
I think we need to look at the Q4 exit margins. I think we should not be looking at next 2 quarters. The 2 reasons. One is obviously we also will get benefited by the margin improvement which will accrue by the CRR cut from September onwards. So there will be a U-shaped curve in terms of the NIM movement, in my view. It will, there will be a reduction in the margins, and then we'll pick up as we move towards the Q4. I think we should look at the end state margin for the financial year, where we will not be badly off. I think both the liquidity availability and the CRR cut, to a large extent, helps us to protect the margins. And as you also know, the incremental deposit rates are getting readjusted faster. Yes. The issue is only on the stock, and the stock will take about 6 to 9 months to meaningfully get repriced.
Yours is a large stock, sir, 30 lakh crore or something. So it'll take time. But if you can put some numbers, your U-shaped is very helpful. But how much does it fall and how much does it rise? I mean, 20 basis, 30 basis, how much do margins fall?
I mean, it's difficult to take give a number at this moment. So we'll also have to see how quickly we can transmit the deposit rates. And that will impact how deep is this U curve and how shallow it is. Yeah.
Mr. Setty, sir, good afternoon. Surabhi here. I just had one supplementary question to your point on growth. What was your expectation for the year, for SBI and for the system at large? And SBI is a giant part of the system. I mean, was it, some economists are saying earlier it was 9-10% credit growth expectation for this year. Now that gets bumped up to 12-13%. What is your assessment? And within that, unsecured, we heard the governor very clearly say that unsecured stress has abated. Should we expect retail to drive the growth? And then therefore, what will be the retail growth, the overall growth, and within that, the unsecured retail portion as well?
So we have given a guidance of 12% for the current financial year. And the system generally 1 or 2% less than SBI. This is a typical the way we look at the industry. But if retail picks up the way we expect now, maybe, we will be in the 13% range, and the industry will also push towards 12% range is what I expect. As far as your unsecured personal loan question is concerned, as I mentioned right in the beginning, it's not only the stress in the unsecured loan seems to be better off. We have not seen, of course, our portfolio is completely different from the industry portfolio, but we also understand from the industry that the large pain on the unsecured loans is no more there, which also gives the confidence that a combination of the softening interest rates and the consumption drive will bring back the unsecured personal loan growth rates, because we almost hit the bottom now on the unsecured personal loan growth rate at the industry level, and it is only probably going to go up.
So if overall growth is at 13%, courtesy the pickup in retail, I'm just trying to understand the number. At what rate do you expect system-wide unsecured portfolios to grow at now?
I don't have that number, Surabhi. Okay. I won't like to hazard a guess now at this juncture.
Okay.
That's a fair point, sir. Thank you very much for squeezing out time for us. And I think the chairman has given us a very